Imagine an investment opportunity worth $50 million, a commercial property, a fast-growing technology company, a renewable energy project, or perhaps the acquisition of an established business. For one investor, the opportunity could be far beyond their reach. But what if 50 investors participated? What if 100 did? Suddenly, something interesting happens. Individual pools of capital can become one powerful investment vehicle, and investors who could never realistically finance the entire transaction themselves may gain exposure to opportunities of a completely different scale. This is the world of syndicate investing. But pooling money is only the beginning. Who finds the investment? Who negotiates it? Who decides what the asset is worth? Who manages the investment? Who receives the profits? And what happens when things go wrong? Because syndication can provide access to larger opportunities, but it does not magically remove investment risk. In some structures, investors may also have surprisingly little control once their capital has been committed. So how does it actually work? Why are syndicates used? What does the lead investor really do? And why might an investor choose a syndicate instead of investing alone? Get to know Syndicate Investors, pooling capital for bigger deals. Today on MP Nerds, we're going deep inside syndicate investing, from its underlying structure and economics to the opportunities, risks, myths, and technologies shaping its future. To understand syndicate investing, begin with a very old business problem. Some opportunities are simply too large for one participant. The underlying idea of combining financial resources is centuries old. Merchants, financiers, and business owners have long shared capital and risk when individual participants could not or did not want to finance an entire venture themselves. Large projects historically demanded large amounts of capital: trade, shipping, infrastructure, property, industry. Eventually, corporate acquisitions and sophisticated financial transactions joined the list. And there was another important reason for collaboration: risk sharing. An investor capable of financing an entire opportunity may still decide not to. Why? Because putting an enormous proportion of available capital into a single transaction can create concentration risk. Pooling capital can therefore solve two different problems. First, it can help finance something too large for one investor. Second, it can allow participants to take smaller positions rather than carrying the entire exposure individually. Over time, increasingly sophisticated legal and financial structures developed around these arrangements. Today, syndication appears across areas including real estate, private companies, venture capital, private equity, lending, and other private market transactions. Technology has also transformed how certain investment opportunities can be discovered, evaluated, administered, and communicated. But the fundamental principle remains remarkably simple. Multiple participants combine resources around an investment opportunity. The complexity begins with everything that happens after that sentence. Syndicate investing does not exist in isolation. It sits inside a much larger investment ecosystem. Depending on the transaction, that ecosystem can involve deal sponsors, lead investors, individual investors, institutional investors, founders, business owners, property developers, fund managers, banks, lenders, accountants, tax specialists, valuation professionals, administrators, technology providers, and regulators. Different transactions involve different participants. Consider commercial real estate. A sponsor might identify a property, analyze its economics, and create an investment structure. Investors provide equity. A bank or other lender may provide debt financing. Lawyers establish and review the transaction documents. Property professionals may manage the asset. Accountants and administrators support reporting and financial records. Now consider a startup syndicate. The environment changes. The syndicate may have a lead investor with knowledge of a particular industry. The underlying company may be raising a financing round. Other investors may participate alongside the lead. Instead of tenants, property management, and rental income, the important questions might involve product market fit, revenue growth, cash burn, dilution, future funding rounds, and the possibility of an eventual acquisition or public offering. The concept is similar. The underlying risks are very different. And this distinction matters. Syndicate describes an investment structure or arrangement. It does not describe the quality of the investment. A professionally presented syndicate can still contain a poor underlying opportunity. An attractive underlying asset can still be damaged by poor structuring. And an excellent deal can still produce an undesirable outcome if investors misunderstand liquidity, fees, leverage, governance, or risk. That is why investors need to examine both levels, the investment itself and the structure through which they are investing. At its core, an investment syndicate brings multiple investors together to participate in an investment opportunity. But let's break that down. Component 1, the opportunity. Every syndicate needs something to invest in. Perhaps a startup needs capital. Perhaps an apartment complex is for sale. Perhaps investors want to acquire a private company. Perhaps a project requires financing. Someone first has to identify that opportunity. Component 2, the lead or sponsor. The terminology and exact role vary, but many syndicates involve a lead investor, sponsor, or manager who plays a central role. That participant may source opportunities, conduct initial analysis, negotiate terms, coordinate due diligence, arrange the investment structure, communicate with participating investors, and potentially oversee the investment after completion. This creates one of the central dynamics of syndicate investing. Investors may rely heavily on the judgment and capabilities of the person or organization leading the transaction. That makes evaluating the sponsor potentially just as important as evaluating the investment. Component 3, the investors. The participating investors contribute capital. Depending on the structure, jurisdiction, and offering, eligibility requirements may apply. Investors might contribute different amounts. For example, Investor A contributes $25,000. Investor B contributes $100,000. Investor C contributes $250,000. Dozens of investors together may provide several $1 million. Component 4, the investment vehicle. The investors do not necessarily purchase the underlying asset directly in their individual names. A dedicated legal entity or special purpose vehicle, often called an SPV, may be created. Instead of the underlying company or asset having a large number of investors participating directly, the SPV may hold the investment on their behalf according to the applicable structure. This can simplify administration, but it also means investors need to understand exactly what they own and what contractual rights accompany it. Component 5, the economics. This is where investors need to pay close attention. The financial arrangements can include management fees, administrative expenses, transaction costs, performance-based compensation, carried interest, profit-sharing arrangements, financing costs, and other expenses. These vary substantially. Suppose an investment generates a $1 million gain. That does not automatically mean the investors collectively receive $1 million. The governing documents determine how proceeds are allocated. Understanding the waterfall, the sequence in which money is distributed, can therefore be essential. The 5-stage syndication process. A simplified process might look like this. Stage 1, source. The sponsor identifies a potential opportunity. Stage 2, evaluate. Due diligence examines the investment. Depending on the asset, this might include financial statements, legal documents, market conditions, management, valuation, liabilities, and operational risks. Stage 3, structure. The investment vehicle, financing, economics, and legal terms are established. Stage 4, raise. Eligible investors are presented with the opportunity and decide whether to participate. Stage 5, manage and exit. The investment is completed, monitored, and ultimately exited or otherwise realizes value if everything goes according to plan. But that final phrase is critical. Investments do not always go according to plan. Let's turn the theory into a simplified example. Imagine an experienced real estate sponsor identifies an apartment building offered for $20 million. The sponsor believes the property can be improved, rents increased over time, and operational efficiency strengthened. But the sponsor does not want or cannot afford to provide all the required capital personally. Suppose the transaction uses $12 million in debt financing and $8 million in investor equity. The sponsor creates an investment vehicle and raises the required equity from participating investors. One investor contributes $50,000, another contributes $200,000, another contributes $500,000. Collectively, The group reaches the equity target. The acquisition closes. Simple? Not quite. Before participating, an investor would typically want to understand questions such as, what exactly am I investing in? What rights do I receive? What is the business plan? How is the property valued? How much debt is being used? Is that debt fixed rate or variable? When does it mature? What assumptions are being made about occupancy? What happens if rents do not increase as expected? How experienced is the sponsor? How much capital is the sponsor investing? What fees are being charged? How will profits be distributed? Can additional capital be requested? Can I sell my interest? What happens if I need my money back early? And what happens if the investment fails? These questions reveal an important distinction. The headline opportunity might be, invest in a $20 million apartment complex. The actual investment decision is far more complicated. The startup example. Now imagine a syndicate investing in a technology startup. The lead identifies a promising company raising capital at a $30 million valuation. 30 investors participate through a syndicate. The company grows dramatically. 5 years later, it is acquired for hundreds of millions. That sounds fantastic. But imagine an alternative path. The company raises additional financing. Existing holdings become diluted. Growth slows. Another competitor enters. Cash runs low. The company eventually fails. The syndicate structure provided access to the opportunity. It did not eliminate the possibility of losing the investment. That leads to perhaps the most important practical principle in this episode. Access and quality are not the same thing. An exclusive opportunity is not automatically a good opportunity. A large opportunity is not automatically a good opportunity. And investing alongside experienced people does not guarantee their analysis will prove correct. Evaluating the lead. Investors should consider more than historical returns. Relevant questions can include, how were previous results calculated? How many investments has the sponsor completed? How many failed? How did the sponsor behave when investments performed badly? Are interests aligned? What conflicts of interest exist? How transparent is reporting? What fees are being charged? How are valuations determined? How much personal capital is the sponsor risking? A sponsor's behavior during a difficult investment may reveal more than their behavior during a successful one. Syndicate investing comes with some powerful misconceptions. Let's examine them. Myth number 1. Pooling money reduces the investment risk. Not necessarily. Pooling capital changes how an investment is funded. It does not automatically make the underlying assets safer. 20 investors collectively purchasing a terrible investment still own a terrible investment. Myth number 2. The lead investor did the due diligence, so I don't need to. Dangerous assumption. A lead's analysis can be valuable, but participating investors still need to understand what they are buying and determine whether the opportunity is appropriate for their own objectives and risk tolerance. Myth number 3. If wealthy or sophisticated investors are participating, the deal must be good. Again, no. Experienced investors make mistakes. Institutional investors make mistakes. Professional fund managers make mistakes. Large amounts of capital can be invested in companies and projects that later fail. Myth number 4. A bigger deal means bigger returns. Deal size and investment performance are not synonymous. A $100 million transaction can produce disappointing results. A much smaller transaction can perform exceptionally well. Scale may create opportunities, but it can also create complexity. Myth number 5. If the investment is profitable, every investor wins. Not necessarily. Fees, expenses, financing arrangements, dilution, taxation, and distribution terms can significantly influence what ultimately reaches an investor. Fact or fiction? Here's one for you. If a syndicate has 100 investors instead of 10, the investment itself becomes more diversified. Fact or fiction? Think about it. Fiction. 100 investors can still collectively own exposure to one underlying investment. There are more participants. That does not necessarily mean there are more underlying assets. Investor diversification depends on the investor's broader portfolio and exposures, not simply how many other people participated in the same deal. The control debate. Another important question concerns investor control. How much influence should individual syndicate investors have? Giving every participant extensive decision-making power can make management extremely difficult. But giving investors almost no control creates dependence on the sponsor. There is no universal answer. The appropriate governance arrangement depends on the investment, structure, legal framework, and objectives. What matters is that participants understand those rights before investing. Syndicates are sometimes confused with investment funds and crowdfunding. They can overlap conceptually, but they are not necessarily the same. Syndicate versus direct investment. With direct investment, an investor may invest directly into the asset or company. Potential advantages can include greater visibility and potentially greater control. But direct investment may require more capital, expertise, and administration. A syndicate can make participation more accessible and centralized. The trade-off may be reduced individual control and additional fees or structural complexity. Syndicate versus investment fund. An investment fund generally pools capital according to a broader investment strategy. Investors may commit capital without selecting every individual investment themselves. A syndicate is often organized around a specific opportunity or deal. Syndicate versus crowdfunding. Crowdfunding can also involve many people providing capital, but crowdfunding covers several models. Some campaigns involve rewards rather than financial ownership. Some involve debt. Others involve equity. And securities-based crowdfunding is subject to legal and regulatory requirements that differ between jurisdictions. Syndication and crowdfunding can sometimes resemble one another technologically, but they should not automatically be treated as interchangeable concepts. Syndicate versus investing alone. This may be the most useful comparison. Investing alone can offer more control, potentially simpler ownership, independent decision-making, and potentially fewer intermediary costs. Syndication may offer access to larger opportunities, access to specialist expertise, shared administration, potentially stronger negotiating scale, and the ability to participate with less capital than purchasing the entire asset independently. But neither model is universally superior. The better question is, which structure fits the investment, the investor's resources, and the risk being taken? The fundamental idea behind investment syndicates may be old. The infrastructure supporting them is changing rapidly. Digital platforms can potentially make opportunity discovery, investor onboarding, document management, reporting and administration much more efficient. And artificial intelligence could influence the process even further. AI tools may increasingly help investors and sponsors analyze financial statements, market data, contracts, business plans, comparable transactions, property information, portfolio exposures, risk scenarios, and enormous volumes of due diligence information. Imagine an investor receiving an opportunity and asking an AI system, "Show me the 5 assumptions that have the greatest influence on the projected return." Or, "What happens if revenue growth is half the forecast?" Or, "Compare the sponsor's assumptions against historical market data." Technology could make sophisticated analysis more accessible. But there is an important warning. Better technology does not guarantee better investments. An AI system can analyze the information it receives, but incomplete, inaccurate, or biased information can still produce misleading conclusions. And human incentives do not disappear simply because software becomes more sophisticated. Technology may improve due diligence. It cannot eliminate uncertainty. Greater access. Digital investment infrastructure may also expand access to private market opportunities. Historically, many private investments have been difficult for smaller investors to discover or access. Technology could continue reducing some of those barriers. However, expanded access creates a responsibility. Access must be accompanied by understanding. Making a complex investment easier to purchase does not make the investment itself easier to understand. That distinction will become increasingly important. Regulation. Syndicated investments can involve securities laws, investor eligibility rules, disclosures, marketing restrictions, and other legal requirements, depending on the jurisdiction and structure. Those rules can change. Anyone considering participation in a real syndicate should therefore examine the applicable offering documents and seek appropriate legal, tax, or financial advice when necessary. The lasting principle. Despite all the technology and increasingly sophisticated financial structures, the fundamental purpose remains familiar. Bring together capital, expertise, and opportunity in a way that can accomplish something individual participants might not achieve alone. That principle extends far beyond investing. It is one of the basic mechanisms behind business itself. People combine resources, they distribute responsibilities, they share opportunities, and they share risk. The structure may evolve, the principle is likely to remain.